Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And on today's episode, which I'm very excited about, we are going to go over wealth tips for when you hit $1 million in worth. But before we do that, as always, the free advice for the day. And this one is profound, so buckle up. Once you know you are on the compounding track to success, take a moment to genuinely appreciate everything that you have. Now, obviously, what I am all about on the show, in my books, courses, all of that, I'm all about getting you to that financial finish line with quantitative strategies and tips and tricks and all that good stuff. However, once you know that you can calculate your compounding success and it's in your grasp, and by in your grasp, I mean by literally just doing what you're doing. Like, you're not reinventing the wheel. It's not going to be that hard for you to get there at this point. You're that close. I want you to take a deep breath and really enjoy the qualitative aspects of your life. This is recorded in 2025, 2024. For those of you that follow me on social media, you know that was a record year for our business. And the brand, our second book came out, all that fun stuff. But that took a huge toll on me. And I remember over Christmas break thinking to myself, okay, like how worth it was all of that? Now, the answer is it was all worth it, but people don't understand the cost of what it takes to actually get to that whatever level that you're trying to achieve. And, because of that, I had this realization of, whoa, I really need to take a deep breath and appreciate the qualitative aspects of my life that Stephanie and I have worked so hard to achieve. And I'm telling that to you because, frankly, I don't want you to go through what I went through during that holiday season. And it was a great season, but it was a tough one in that regard. And you may not think that that's a big deal, but trust me, when you get there, you will thank me. So with that being said, it is time to get into the wealth tips for when you hit $1 million in worth. So the first thing I want you to do is I want to talk about evaluating your financial goals. Now, a lot of people ask, they come to me and they ask, am I on track to retire for retirement? Am I on track to retire early? Now, I want to kind of pump the brakes for a second on your excitement when you hit $1 million, because just because you have $1 million, that does not automatically mean that you are ready for retirement and or early retirement. And that's a common misconception that people have in their head. Like, people will come in and they'll go, hey, I need to be worth X amount, $1 million, 500,000, 4 million, like whatever the number is. I need to be worth this and then I can retire. That is an incorrect way of going about it, my friend. What you need to understand when it comes to retirement specifically is, given the monthly expenses that you incur regularly, what interest rate are you able to earn off of your portfolio in tandem with Social Security to give you that lifestyle? And you're not just setting it in one portfolio. You need to be very dynamic in the mind when it comes to your money, because monies act differently. I talk about this in my book excessively. And so it's different interest rates with different types of monies, and being dynamic within your mind to understand in tandem with Social Security, oh, now I can make sure that I have X amount to live off of per month. And that does not really correlate or relate to what that number is. Oh, I need to have $1 million in this case. And before we move on, I would highly recommend, if that just kind of went over your head, pause and re-listen to that segment, because it's mission critical that you know the difference between what you thought you knew and what you really need to know in that last segment. Now, another thing that I want to talk about is reassessing your lifestyle upgrades and the impact on long-term goals. So just because you hit $1 million, and I'm not degrading $1 million. $1 million, like if you hit $1 million, good for you. That is awesome. You should be really, really proud, because a lot of people will never get to that. However, I say that because for whatever reason, when people get to $1 million worth, they start to do silly things with their money, which is odd because most people, when they saved $1 million and have invested it and they've gotten to that point, you clearly know what you need to do, more so than most people. But yet when you get $1 million, you suddenly take the foot off of the gas when it comes to prudency, and then you just start making really silly decisions. That is something I always struggle with and wrestle with in my mind. But just because you hit that certain dollar amount, this does not mean you need to level up your lifestyle. Now, there's exceptions to that. So if you're basically broke and you start making more money, it's nice to have breathing room. So if you're damn near broke and now you're no longer broke and you're still living as though you're broke, you need to give yourself some grace. However, once you make, this is crazy, once you make $75,000, anything more than that does not provide you more happiness. Okay? Anything more than $75,000 in income does not provide you incrementally more happiness. There have been a ton of studies on this. Now, you also need to know that with $1 million, or as your money grows, the more your money compounds, the more financially your life will become complicated. And I could argue just complicated in general. In theory, it shouldn't, because it shouldn't. But just trust me, it gets more complex. And I would tell you to keep your life, financially speaking, as simple as possible for as long as possible, especially when you hit that $1 million mark, because naturally complexity will come as you become more successful. And we're actually going to talk about that later on in this episode. Now, the second thing I wanted to go over is tax efficiency when you have $1 million. So there are a multitude of strategies out there that mainstream media projects, financial influencers project, your next door neighbor projects. And I want to go over a couple of the most popular. And I'm not saying that they're not valuable, but people need to stop thinking so surface level. They need to think deeper, and they need to think more comprehensive. So yes, there's a ton of strategies out there. The first one I want to go over is tax loss harvesting. So what is tax loss harvesting? Tax loss harvesting, if you have a portfolio, and if you got $1 million, you have a portfolio, unless you're just sitting on $1 million, and then, we got another slew of issues, but that's beside the point. Tax loss harvesting within a portfolio. And this does not include like retirement accounts. This is a non-retirement investment account, a brokerage account. What that allows you to do is, if you have gains in your portfolio, like let's say an investment goes up in value and it's done really, really well, and by the end of the year, November and December, you're like, oh, I'm going to pay a lot of tax in April of the following year. But one of these investments actually has a loss. So I'm going to offset that gain with that loss and harvest the loss so I avoid the gain altogether, and therefore I don't pay anything in taxes come April 15th of the following year. Pretty cool, right? And it can be very cool. I'm not saying tax loss harvesting is not important. We used it a ton in our clients' portfolios toward the end of 2024. However, tax loss harvesting is not necessarily as valuable as you may believe it to be. So I'll give you an example here, and it kind of ties in. So there's two types of taxes when it comes to your investment portfolio. There's ordinary income, short-term gain, and then there's long-term gain, which is a year or more of holding an investment, and that's capital gain. So if you sell an investment and it has a gain within a year, it's ordinary income tax. That is tax inefficient. When it comes to investing and you hold something for longer than a year or more, it's a capital gain. You're taxed in a lower tax bracket. That is generally a really, really good thing. I say this because a lot of planners get so obsessed with tax loss harvesting, you're actually missing out on opportunity. So I'll give you an example here. There was an investment back in 2020 that we made. And I'm not going to say the name of the company or any of that for a plethora of reasons. But I remember the share price was in the low teens. Actually, it may have been like $10 a share. Let's just go with 10 for easy math. And in 10 months, the investment went from $10 to $100. Now, we ended up selling a lot of it. And we had clients that were upset because, we're paying ordinary income. You just 10x'd your money in 10 months. So even after the ordinary income tax that you're going to pay, clients were still netting, like net of tax in the 60s in terms of returns. In some cases, even higher. So what I'm saying is, if we waited 2 months, which I'm glad we didn't because then the stock actually decreased substantially, sure, we would have paid long-term capital gains, but the client wouldn't have net after tax made nearly as much money. Like sometimes tax loss harvesting in taxes go out the window when you have a monumental gain in your portfolio. And that's okay. It's going to suck come April 15th when you pay the taxes, but don't get overly obsessed with just, I've got a tax loss harvest, or I've got to do this, or I've got to do that. Now, also one thing I need you to understand, you can't like cross-pollinate. So if you have an ordinary income gain, like a short-term gain, you can't offset that with a long-term loss. They have to be like kind. So capital gain, capital loss, short-term gain, short-term loss. Now, another strategy I want to talk about is the concept of a municipal bond. And the reason why municipal bonds can be really valuable for like short-term needs for clients is especially in states where you have a state and a local tax, and you're just getting pounded by taxes. Municipal bonds, you're avoiding all that tax. Like it's completely tax-free. However, municipal bonds, like what is a municipal bond? You're investing in municipalities, like local communities. Municipal bonds have their own risks. And so just because it is paying a tax-free type of return versus a taxable return with a government type of bond or a corporate bond, I can make the argument, and I've seen this in the past, where sure, this municipal bond is paying a tax-free return, and after tax with government bonds or a corporate bond, you may not be earning as much and it's a sliver. But what if that municipal bond can't pay the bond back? That municipality can't pay the bond back. Then you're screwed because that money just goes, poof, it's gone. So again, I'm not against municipal bonds, but what I'm telling you is sometimes it makes more sense to just have a less tax advantage bond in this specific case and take the unnecessary risk off of your plate. And if you need to listen to that again, rewind it and marinate on it. Now, another thing I want to talk about before we go into the commercial break is the importance of Roth conversions and charitable contributions. Because if you've got $1 million, chances are your taxes are not low, which stinks. And so you need to think about these things. Now, I get a ton of questions when it comes to Roth conversions, both in my practice and through social media. And what is a Roth conversion for those of you that do not know? So if you make too much money, I'm not going to give you the limits and all that. That's beyond the scope of this recording. If you make too much money, you cannot contribute to an individual retirement account, an IRA, and get a deduction, assuming you have a 401k available at your fingertips. So what a lot of these people do is you go and you contribute to an IRA, and then the next day you convert that IRA, even though you didn't get a deduction for it, to a Roth IRA, and it's called a backdoor Roth IRA conversion. And you're not getting a deduction, so you pay the tax on it anyway. And you can't contribute to a Roth IRA directly because you make too much money. So that backdoor conversion option gives you the ability, even though you make too much money, to go and contribute to something that will grow. The gains will be tax-free. So that's Roth IRA conversion 101 for you. Now, I'm going to discuss my own situation with me and my wife. I'm not going to give you specific numbers and all that. Because a lot of people will go, oh my gosh, I want to do, I want to use Roth everything, Roth 401k, Roth IRA, because, taxes aren't ever going to go down, which you can't necessarily guarantee that. And I want to have all this monumental tax-free income and growth when I'm in retirement. Okay. I don't totally agree with that. So what my wife and I do is we go and contribute to our 401ks, her 403b, because she works for a hospital, my 401k through my company, and it's all pre-tax. Why? The greatest investment that you can guarantee is not an investment. It is the taxes you avoid. And by doing that, my wife and I will avoid the tax bracket that we are in, which is not particularly low. Full disclosure. Okay. And then what we do is the backdoor Roth IRA conversions. Now, the reason why we don't do Roth 401k contributions to our retirement account is because, and I'm thinking, and I'm 33 for those of you that are new to the show, I'm thinking by the time we're in our 70s, when you're in your 70s, and I'm going to say 70s in general, because by the time we get there, this law is going to change. I can almost guarantee it. But as of today, if you are 73 and you have to take these required minimum distributions from your individual retirement account, because when you retire, a 401k becomes that, you roll it over, you can take up to $100,000 of whatever that required distribution is and convert it to a qualified charitable distribution. And what happens is that money goes directly to the charity or charities of your choice. And what's cool is you can be charitably inclined and the government never sees that money. So you never pay a dime on that tax ever. So for us, we're using our 401k and 403b purely for full-blown tax strategy. Now, again, it's up to you, okay? There are a number of different opinions out there. I'm not against people not doing that. I do think if you've done really, really well, you should give back something. But I also don't know what's going on in your life. So you may be saving up for something that we don't know about. Okay, whatever. We live in a complicated world. So if you want to make the Roth IRA contributions and the Roth 403b contributions, go for it. But because again, it's not a bad strategy at all. If you're more inclined to do something that me and my wife are doing, go for that. Because again, I would much rather avoid the taxes today. And then by the time we're in retirement, if we have to take distributions from our 401ks, which will be IRAs. Again, major if, chances are tax brackets, you're going to be in a lower tax bracket in retirement. So you make money on the spread anyway. Now, as for charitable contributions, Unfortunately, as of 2025, the standard deduction is really, really high. So right now it is $15,000 if you're single, $30,000 if you're married filing jointly. So if you can't contribute above and beyond that, and I'm not getting into like mortgage deductions and all that other stuff to get to your standard deduction limit, just keeping it really simple. Most people will not be able to get over that limit for you to, instead of standard, take the standard deduction on your tax return, you take the itemized deduction, where if you contribute more than $30,000, you can actually write all that off. However, if you've got $1 million, generally speaking, you're closer to that ability than most people. So, there could be a really strong argument for contributing to charities or a charity of your choice. And that further decreases your taxes by hopping off of the standard deduction and choosing to itemize. Okay. Now, we are going to take a quick commercial break. And then when we come back, we're going to get into risk management. And then we are going to get into diversification and wealth protection. And lastly, we're going to touch on philanthropy and legacy building for you millionaires. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We're going to get right into this episode because we've got a lot to cover still. And we're going to talk about risk management when it comes to you millionaires out there once you've hit the $1 million in net worth. Now, one seemingly sound piece of advice, and if you're not watching, there's quotes around seemingly sound advice, is adjusting your portfolio's risk tolerance once you get to $1 million. This is massively incorrect advice that our industry has spewed upon you. And I'll answer it with a simple question. Why would you change what has worked for you all of these years? That make a lot of sense. Now, it's also worth, and we talked about this a lot, re-explaining the risk side of things that our industry has talked about incorrectly. And I've spoken about it so much in past episodes, but so I'm going to bullet point it for you. Risk is not the emotional intelligence that you have with money. Meaning, I'm aggressive or conservative, and I match my unintelligence with money with how I feel. That's not it. Risk is much more simple, and it's much more complex than that. When it comes to $1 million, a lot of these things you can kind of throw out the window because, frankly, they are unnecessary as far as like the emotional unintelligence with money. So instead of like bombarding you with all these risk type of conversations that we talked about in the past, I'm going to give you another way to think about it. So let's say that your $1 million is paying you 4% a year. So that's $40,000 a year or $3,333 a month. And again, just bear with me with the example here. I also want to assume that you only need that monthly income to live off of. So if you know that in your portfolio, the companies, if it's stocks or real estate, whatever, if you know that those investments are comfortably paying the dividends or incomes without any truly major risk of cutting those incomes, why on earth Would you take money out of an investment that will grow over time to invest in something that will provide you no increased income potential and lose to inflation? Doesn't make a lot of sense to me. And I don't think it makes a lot of sense to you. And that is why simply changing your risk tolerance because the industry told me to because I'm older is absolutely ludicrous. It is beyond silly. And by the way, what I was talking about were long-term investments, taking money out of those to go into shorter-term investments. Way back in the day, this is archaic when it comes to planning, but what planning was is you would take 100 and then you would subtract your age. And then whatever that number is, that is how much as of a percentage you should have as far as stocks. And then anything left over should be invested in conservative investments, traditionally conservative, like bonds or cash. Okay. And I'm not going to get into the weeds of it, but like that is so wrong for a number of different reasons that it's substantially silly. Okay. Now, you also need to review your insurance needs. And this strategy, when it comes to being a millionaire or multimillionaire, is highly underappreciated. So if you have $1 million, chances are you are on the verge of self-insuring for long-term care. However, with the way long-term care works today, it's actually more affordable than ever. And what I would do is if you're talking to an insurance specialist or your certified financial planner, ask them, okay, this is how much I could afford on a monthly basis. And then your planner and your insurance team, your planner should be the one quarterbacking this, should be able to get together and give you strategies where you can pay up on a monthly basis. Of course, if you've got a lump sum, you can do that. Like that is an option. But you can do it on a monthly basis and you don't have to do it forever. It could be like for a set period of time of 10 or 20 years or something like that. You can also, as a quick little segue, you can combine long-term care with life insurance. So if you don't use your long-term care, meaning like it's a nice way of saying you died before you could, you still get the death benefit for your heirs. So there's a lot of different ways you can skin that cat. But another thing that you need to look into when it comes to insurance is estate planning. And especially if you're in a state with a state tax, like my lovely state of Washington State. So I want to briefly explain how this works. So as of this recording, the exemption in Washington State is $2.193 million of a taxable net worth. So if you are worth under that, and your money goes to your heir or heirs, your estate will not pay any estate tax on that. Federally, as of right now, it's like $13 million. It's probably going to sunset in 2026, but that's beside the point. In our state, it's $2.193 million, which blows. So let's just pretend that you're worth $4 million. So 4 million minus 2.193 million. Also, let's assume you're single because with married, you get double exemptions. It gets a little complex, whatever. So you have $1.807 million of taxable estate that will have to pay tax because you're dying on this great soil. Being a little facetious here. So you take the 1.807 million, and I'm looking on the tax table right now, just did the brief calculation. Out of that 1.807 million, you would owe $212,980 simply for dying in Washington State. Unless you use an insurance strategy with that. So the easiest way to not even think about it, the easiest way to use this is to set up something called an irrevocable life insurance trust, ILIT. And again, I'm not giving estate planning advice here. I am just saying what I see in my practice all the time. And you set up this irrevocable life insurance trust, and then you fund it with a life insurance policy that has a death benefit of, and I'm just going to round up to $250,000 here. And then what happens is that policy pays for the estate taxes. So your heirs in this case would get $212,980 that they don't have to pay to the government. Pretty cool. Now, a huge no-no is, and I see this way too often, which is crazy because these people are in my industry, which makes me really sad. What they will do is they will tell their clients, hey, we're going to set up this insurance policy. I'm just going to use this example for $250,000. Client goes, great. And then they put it in the client's name, not the trust's name. That is a huge, huge, huge no-no. Because when you set it up, what ends up happening is you've got your net worth, your estate, and then the trust, the irrevocable life insurance trust. It's its own thing. So when you die, Washington State, in this case, comes in and says, okay, you're going to owe $212,000 for the privilege of dying on this soil. The trust is notified that the owner, you, have passed away. And so that death benefit comes in and swoops in and saves the day and pays the death benefit for you well, not you because you're dead, but your estate and your heirs. Now, if you have a permanent life insurance policy already, but you don't have an irrevocable life insurance trust, go talk to an estate planning attorney. Again, assuming an ILIT is the right strategy for you. And then you can simply convert the ownership and transfer that policy into the trust. It's pretty cool. Now, I also want to talk about diversification and wealth protection. So again, we've talked a lot in the past about diversification and how it is overblown as far as importance. I'm not saying it's not important, but it's not as important as you may believe it to be. However, generally speaking, and I just see this in my practice all the time, the larger the dollars, the more comfortable people are with spreading their wealth throughout different strategies. Okay, whatever. I'm not saying it's good or bad. I'm just saying that's the way it is. So if that's the case, you may want to consider some alternative investment strategies, especially if you're growing your net worth. There's an ample amount of research out there that says that can be very, very valuable. Again, I do want to stress, if you want to keep things as simple as possible and you don't want to get complex, $1 million simple plan and $1 million complex plan, it doesn't matter. $1 million's $1 million. Okay. That being said, there are a number of other long-term options out there that are not purely stock market related. We see this a lot in our practice. We do this a lot in our practice. But if you're working with a planner right now, or you're just doing it on your own, do some research on other strategies that will be complementary to what you have been using. Now, I also want you to know that when it comes to wealth preservation, setting up trusts or estate plans to protect your wealth is a must. And again, I need to reiterate, I am not giving estate planning advice for these compliance people out there that are going to just be grilling me on this. I am just stating what I'm seeing in my practice all the time. Okay. And I also don't want to get too into the weeds with estate strategies, again, more for compliance than anything, but really because estate planning is the Wild West. I mean, there's so many different strategies and tips and tricks and trusts that you can set up for you and your family. And regardless if it's and I'm just going to name a few, and again, for no other reason, just for you to think of other ones out there. There's generational skipping transfer trusts. There's Q-tip trusts. There's dynasty trusts, irrevocable life insurance trusts, which we talked about earlier. Those are just a few strategies that are pretty commonly used within estate planning. I just need you to know that there's a mountain of options out there, and that your certified financial planner and your estate planning attorney need to sit down with you to get a solid game plan going. And that's key, because once your estate planning attorney creates and constructs these trusts and the skeletal structure of these trusts, then your certified financial planner or you can go and invest that money according to the rules and guidelines that the trust has laid out. That is mission critical. Now, I also want to talk about philanthropy and legacy building, because this is extremely valuable, especially if you've grown your net worth to $1 million. So you want to establish some type of charitable giving strategy. And again, earlier I did mention that if you don't have any charity or charities that you want to give to and you just simply haven't thought about it, okay, that's okay. Or if you have like an upcoming purchase where you need to be saving prudently from a risk standpoint, I totally get that as well. But a charitable giving strategy is one of the easiest strategies out there for you to act on because you can give on a monthly basis. You could write a check once a year for a lump sum. There's a number of different ways that you can do it, but it's really up to you as far as how you're giving to these charities. But there's also cases where you can set up different types of strategies. So there's something called a donor advised fund where you can basically contribute to this fund, and then that fund will give to charities basically on your behalf that you and your basically the donor advised fund have agreed upon are of value and they match your values. And if you really, really, really wanted to set it up and level it up, you could even set up a foundation, which comes with a multitude of benefits. However, it doesn't necessarily give you the privacy that many people in this situation want, because you have to disclose a lot of things publicly. So when you're giving, what I want you to understand, for you that have hit that $1 million worth, really weigh how you want to give, as there's a balancing act between tax strategy and the academic side of what you're trying to achieve, but then also the privacy and solitude side of your money. And a lot of people don't like to talk about that. They just jump in because they want themselves, frankly, be a lot more valuable than they may actually appear. And all I'm telling you is it's okay to not necessarily go full tilt on the academic side of things. And that's coming from a guy who did this for a number of years. There's a balancing act there. Now, passing on generational wealth responsibly is something that you really need to think about here, because there's a multitude of opinions on this topic. And, I'll go with one that, and I know it's cliche to talk about Warren Buffett on a money show, but Warren Buffett is famous for saying that his children will not get 99.99, maybe 9% of his fortune. Charity or charities will. Now, technically, because I've thought about this, each one of his kids have foundations, so I don't know how true that is, because you don't know exactly where his money is going to go. And if his money is split between his kids' 3 foundations, it's kind of like, all right, you kind of lied there, but that's beside the point, okay? There are other people that want their money to stick within the family, but they want guardrails where the kids or grandkids, they can't suddenly blow through the money once their parents or grandparents drop dead, or whoever's giving them the money. And then there's also people out there that they want to have trusts and everything set up. However, once the money holders die, so the grandparents or parents in this example, the heirs essentially get the money free reins. Now, a lot of people ask, where do I stand on this? And you're not going to necessarily like my answer, because it depends on the heir and how many heirs are involved. I'm not going to give you a specific example on how I feel with my situation, because as of this recording, my daughter is 2. So she is, Abby, I love you to death, but I am not confident that you could balance our portfolio to the best of your abilities. However, as time goes on, Stephanie and I will find out how responsible Abby, or God willing, if we have more kids, or even someday grandkids, way down the road, how responsible all of them will be. I don't know. But for you, it really depends on the structure of the patriarch of the money situation, whether there are foundations or trusts or not, the responsibility that heirs or an heir has with money or doesn't. There's really just there's so many factors that I simply can't give a blanket statement on this. So I'm not going to do that. But what I will say is that it is worth your time asking yourself everything I just laid out, because you and only you will truly know what is right for you, your family, and your finances future once you are gone. So that does it for today's episode on wealth tips for when you hit $1 million of wealth. I had a blast researching and writing this episode. Obviously, if you have any questions, there's a multitude of ways you can get a hold of me, and you will hear from me next week on next week's episode. So as always, closing it out, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Examples cited are hypothetical or for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Municipal bond interest may be subject to the alternative minimum tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims paying ability of the issuing insurance company and are subject to their terms and conditions. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial California Insurance License Number 0518721. LPLIA California Insurance License Number 0B91442.